Hi, everybody. My name is Philip, and I'm here with my colleague Craig from the Templeton Global Equity Group. And we're delighted to present to you today on how to create a stock pitch. We're both part of the investment team here at Templeton Global Equity, where we conduct fundamental research and then sort of present on stocks in different public companies. Craig's a leader, the lead portfolio manager of our climate change strategy, and my name's Philip, and I'm a research associate working very closely with him on that fund. We have pretty varied roles on the team, but analyzing companies lies at the core of what we all do. So to begin with, what actually is a stock pitch? Well, that's basically a recommendation about the shares of a company. Pitching an idea, or a stock as we call shares, is a key aspect of what we do in our job as analysts. Basically, the purpose of the pitch is to communicate an analyst's idea about a company to the fund managers in order to help them make the best decisions. Many analysts will follow a process similar to the one shown on this slide. Indeed, that's the way we do it on our team. And basically, we make the recommendation on a weekly research meeting, which takes place on a Teams call. It goes more or less as follows. First, the analyst will submit a note and the company model to our database. That's usually the week before the research meeting, and then they'll get a slot on the call the following week to deliver their pitch, and then field questions and kind of facilitate a discussion from other analysts and fund managers on that call. Generally, a recommendation is made when the analyst changes his or her view on whether the stock is a buy, hold, or a sell at the current price it's trading at. This change in the view can be brought about by many things. So things like the recent share price moves, for example, actions of company management, the economic outlook, or a combination of all of those. So how do you pitch one? Well, I think actually of pitching as the final step in the analysis of a company. Remember, the purpose of the pitch is to communicate your idea. So before you can communicate it, you need to have done enough work to basically understand the company really well, build your conviction in your idea, and to convince others of the idea's credibility. We broke this down to 4 steps that we think are crucial. We'll get into each one of them individually in the following slides, but basically, you need to understand the company first, then forecast its future, then arrive at a valuation relative to that forecast, and then finally communicate the idea to your peers. All right, so understanding the company. Well, to start with, the analyst will start looking at a stock by familiarizing themselves with the company's operations, its history, industry trends, and other sort of softer facts. They'll also look at competing companies to try and understand how the business is positioned relative to the main competition. As well as these kind of softer facts, the analyst needs to understand the company's economics. So that is the relationship between its profitability and then other fundamental factors like its raw material prices, the cost of its employees, interest rates for its loans, and how much it's able to charge. That's known as its pricing power. This basically allows the analyst to understand how the company behaves when, for example, the price of raw materials changes or there's an interest rate increase. Basically, to build this understanding, you should try to think of the business in the simplest possible terms. Basically, almost every business that sells something has to buy something first. Then they have to process it and then sell it for more than it cost them to make, hopefully at least. Consider a coffee shop. That shop has to buy some raw materials in the form of coffee beans, and then has to also buy water and milk. The production sort of stage is, the operating costs. Quite straightforward in this case. It needs a coffee machine, it needs to pay a barista, it needs to pay rent for the premises, and it needs to pay its bills. So as well as those raw materials, so the beans and milk, and the operating expenses, so the barista and the machine, we have to think about the sales that this business is going to make. So is it operating locally? Are there any other coffee shops in the area? Who's the competition? Is there a more conveniently placed coffee vendor for the customers? Is there one by a train station, for example, with lots of commuters? Is coffee a one-off purchase or a repeat purchase? Do you buy a cup every day? Being able to kind of show that you understand these various factors and the kind of business's relationship with them is a crucial part of what we do as analysts. And it's something that for you guys, if you're in an assessment center for an internship or an interview for a full-time role, that's something that your interviewers will definitely pick up on if you can demonstrate that you understand this relationship. It's also worth keeping in mind that different companies and industries will have different cost and pricing schemes to consider. So businesses that are reliant on commodities might insulate themselves from commodity price fluctuations by basically passing on the price of raw materials in the pricing. Similarly, companies in more volatile industries might hire temporary workers, so then they don't face a big wage bill when the economy slows down. How do you find out all of this stuff? That's a lot of information. Well, it is, but a lot of it is actually available for free and available publicly. So the companies publish annual reports annually, hence the name. And there are also periodic updates, usually every quarter, that the company updates on its investor relations pages. In our jobs, we also have access to kind of specialized tools that make this a little bit easier and more in depth. So products like Bloomberg or FactSet that basically help us analyze the data more thoroughly. But having said that, you can do a very good job of analyzing a company without these tools and just going off what the investor relations page has on it. The analysts will basically use this data to model the company's historic performance and get an idea of how it's been doing business and growing historically in the past. And then looking at charts of historical share prices and earnings per share is also helpful because it almost like paints a picture of how the company's reacted to previous events like financial crises, pandemics, government policy changes and announcements, wars and invasions, such as the one recently, and periods of low interest rates and periods of high interest rates. So it's quite good to get a kind of picture of how the business fares in different conditions. Anyway, the next step, once you've understood the business, is forecasting the future. And for that, I'll pass on to Craig.
Thank you. Yeah, so after looking at a company's past, the next thing to think about is its future. How do you think sales might evolve? What's going to happen to the demand for this company's products or its services? And how sensitive are its profits to potential changes in things like raw material costs and other variables? These are all things that an analyst must consider when forecasting the business. If, for example, you believe that the company's products will be in high demand in the future, or that it can remain highly profitable, or even that the future economic climate will be beneficial to a company's operations, these are all things that you can build into a company model and help to explain the business through the numbers. So let's say we forecasted a company and the business looks attractive. We have to keep in mind a great company is not always a great investment. So how do we define a great investment? How do we look for the best opportunities? Well, it's not just by considering fundamentals. We also have to consider these fundamentals in light of the current price. When you go to a shop or a grocery store and you're looking to buy something, you would always consider the price that you're paying as well as what you're getting back. And I think that's something that is just as important in the stock market as it is in everyday life. We might have a company that has a forecast of growing sales and good profitability, but the company might not be trading at an interesting valuation. So what this means is the share price might already account for those really strong factors. In fact, in some cases, you can find companies that are probably overvalued relative to expectations. Take the table on the right as an example. Here you can see, a theoretical company and under two scenarios. The first is that we pay £100 for the stock, and the company is paying out a £10 dividend every year. Let's assume that nothing else changes and that company just continues to operate in that way going forward. Well, we get a pretty attractive 10% return that we can make for our clients. Most people would tell you 10% is quite a good return, and therefore we're doing well for our clients in that scenario. Then consider the situation where this company is worth £500 and it's still paying out a £10 dividend. In that same type of company, but because we've paid a lot more, suddenly we're only making a 2% return for our clients. Now, of course, there's many different ways that you can make a return, whether it's the dividends the company pays or the change in its share price. But the important thing to understand here is that price can have a big impact on the returns that you make, rather than just picking the right companies. Another way to think about this is to consider yourself as an asset owner. We try to imagine a typical scenario. Consider that you have some sort of investment. Let's say you have a flat or a house that you rent out. In that case, the cash flows that investment receives are the rents from people that are living in the property. Similarly, when we own shares, we think about the cash flows that those companies are paying out to us through, for example, dividends. The way we want to value an asset is to think about what all of those future cash flows into the, well into the future are worth, and think about what they're worth today, so in today's money. In that case, we have to discount each of those cash flows back to today, in the same way that £100 next year is worth more than £100 in 5 years' time or in 10 years' time. So we want to try and understand today's value of each of those cash flows. We also want to account for the risk. So, for example, if there are other uses of our money, for example, putting it in government bonds, and the risks that we take by investing in this business. So, we can't always rule out the possibility that our forecasts are wrong, or even that a business might fail. Investors generally consider this sort of present calculated value of a company as its intrinsic value. You can think of that as the absolute value. So looking at a company's business and cash flows in isolation, and deciding whether you think the company is over or undervalued. Naturally, the most attractive investments are the ones trading below intrinsic value. And this is obviously in light of the risks that we are taking. What I'm essentially describing here is what we would call a discounted cash flow analysis, or DCF. Many rules about things like price to earnings multiple or earnings growth multiple, you might have heard of price to sales or price to book multiples. All of these things are really just a shortcut in doing a DCF. Analysts will generally then come up with a recommendation, looking at the prevailing share price today, compared to those fundamental prospects and the valuation, of course, and decide to put a stock on a buy, hold, or sell. Many places will have different rating structures, but we tend to operate with just the three categories. And a DCF is also not the only way that you can value a business. For example, if you were more focused on relative value rather than absolute, then you might be looking at what we would call comparable multiples, or a peer valuation. 5 companies in the industry all trade at 12 times earnings. This company only trades at 9. Therefore, there's an opportunity for this company to catch up, and we can make a return relative to its peers in the industry. Now, that of course assumes that the other companies are fairly priced. And so all companies could be more expensive, but you would still be making relative value if that gap did close. Another way to think about valuation is the sum of the parts. Here, what we're thinking about are large conglomerates, essentially several different businesses that all operate as one. Think about some really big companies like Amazon or Google. Here, we might break down these businesses into several different pieces and then try to value each of them accordingly. That might be with peer comparable multiples. It might also be using that discounted cash flow analysis. One thing that I think is very important is remembering that there are lots of other people out there doing the same work at the same time as we are. The market has many, many participants. And so, for example, if a company has very strong prospects, many other people will already know that. So we should always be asking ourselves as analysts, what do we think the market is missing? What is it that we have, or what unique insights do we have that can help us to determine why this company is worth more or less than its current share price? So when an analyst has arrived at a valuation for the business and decided on their recommendation, for example, a buy, hold, or a sell, they will put together a research note, which is a supporting document that might summarize their investment thesis. It would have assumptions and a forecast for the business outlook. Often this would include things like charts or tables, helping to explain some of the drivers that the analyst is discussing in the note. Now, once you've made your note, it's time for your pitch. We think there are three things that are crucial when it comes to getting across the message. And I think also things that will stand you in very good stead if you are doing this in future, either at a job interview or an assessment day. Brevity is number one. We think 5 minutes is the sweet spot for timing, and it leaves a lot of space for question and answer afterwards. It's crucial to us that analysts can get across their key points in good time, and before they've lost the audience's attention. The second tip is somewhat similar, and that's to keep your pitch focused on what really matters. It's fantastic and very impressive if an analyst has done enough work to be an expert on every single part of a different company, but the audience doesn't always need to know that. In many ways, the most impressive an analyst can be is knowing the business so well that they can convey the message and explain the company within those few minutes, rather than going into a lot of detail. Ultimately, your audience or the fund management team will just want to know what the key message is. What are the key factors that are driving this company's profitability, and why do you think they will be better or worse than the market is expecting? The third and final point is to be very open about uncertainty. It's almost impossible to have a model that considers every eventuality. The same is true for the research note as well. So openly flagging areas that need further work in your note, I think is very good practice. And that helps your colleagues to understand what areas your knowledge might be lacking, either because data is unavailable or because there's just too much uncertainty. That's actually something I included in my research note when I first applied here many years ago as well. It's also good from a communication standpoint. So analysts and portfolio managers might have worked on similar companies that have the same uncertainties that we're dealing with, and they might be able to offer valuable insights, which can be helpful to you and the discussion overall. I think the key to remember here is that this industry does have a lot of jargon. It can often be overcomplicated, but if you really focus on a company and understand what matters for its profitability, you'll probably find it's quite an interesting and I think quite exciting process to work through. It's really a great way to learn a lot about a company and understand an industry. So we're going to stop there, and thank you very much for your time and listening, and best of luck.